Good morning, everyone. In today's video, I'd like to go through our 10-minute morning volatility process, take you through that journey to understand what volatility looks like on this Monday morning. We've seen volatility has picked up quite a bit, at least over last week. This was Friday, this was Thursday. So far today, this is Monday. Obviously, the day is still just begun. We're at 7 a.m. Pacific as of right now, and our goal is to understand what does volatility look like in the major index markets. Let me pull up this snippet real quick. So this is from our trade plan right here, where it gives you an idea of what we do at different times. We're currently at the 7 a.m. mark right now, which is when we can determine the volatility for the final markets we trade, including the indices, which is what I think most people care about. I'll link the actual process video, this 10-minute process video, in the description box, but this video is much more about actually doing as opposed to talking about how to actually perform the process. So if you'd like to learn more around the how, this is the video to take a look at. And then I'll also link our adapt to changing volatility conditions video, which walks through what to do as the day actually progresses here and if we go outside any of these clouds. So this video will give you an idea of what to do for the rest of the day. This is a video that gives you an idea of what to do in the morning so you have an idea of the volatility. So let's get started with the process. So here I have the 10 futures markets. At the top, I have the 5 different models we have, along with where we start with each model for each market per day. So in the S&P, the Dow, the Nasdaq, and the Russell, we start with our Scalper, which is the most aggressive model we have. Really, this goes from aggressive right here all the way to most conservative, really scaling up along the way. So in the 4 major index markets, we start with the Scalper, and in gold and silver, we start with the Scalper. In the remaining markets, which is the 30-year bond, crude oil, natural gas, and copper, we start on our aggressive volatility box models. Particularly 2 markets to call out here, 30-year and crude. We're also studying on the Scalper, but that model is not currently available. So now let's go through the physical process. Inside of the S&P here, we're seeing a bit of a sell-off right now, but as of this current moment, the Scalper was the one that was respected. We had breached the sign entry lines. We bounced up at least 5 points. We bounced up 10 points from our models. So that's letting us know that, hey, the Scalper is good to go. We're now breaching our second hour sign entry lines as well. So now if at this point, if in the S&P we continue to bounce, then hey, we know that the Scalper right here is the one that we can continue to use. Now, if on the other side, if say price action in the S&P goes outside of the clouds, then we know that, hey, we need to adapt to volatility and switch from the Scalper to our aggressive model. And again, this is the video that walks through how to go through that process, the adapt to changing volatility conditions. So now let's come back in here. So we know the S&P is currently so far on the Scalper, but we're monitoring to see what happens at this current juncture. So far, it looks like the S&P is bouncing from there. If we make a move of at least what is the distance from our sign line to the outer edge of the clouds, 5.22 points, so 5.25 in the S&P, we know the Scalper is good to go. So that's the S&P. Now let's come into the Dow here, and we'll come back to the process at the end to get an idea of where volatility ended up at. So inside of the Dow here, we'll see no breaches so far, so the Scalper is the model we can continue to use. That then implies if we come into the Nasdaq here, given the S&P is seeing more volatility, that's stemming from the Nasdaq. And you can see that very clearly right here in that first hour where price action went just straight through our clouds. So we know the Nasdaq, we can't use the Scalper models. In fact, the Scalper's already been broken, so let's try and adapt to volatility here. If we go from the Scalper to the aggressive, let's see what that currently looks like. If price action stayed inside of our clouds here, we could have used the aggressive, but even inside of the aggressive models, the Nasdaq has just continued to keep going outside, letting you know there's a good deal of weakness inside of the Nasdaq so far, the more volatile out of the index markets. We keep adapting. We come into our next model down the line, 1, 2, 3, 4, and 5. Even inside of the Doomsday Aggressive, we went outside, so that now takes us into our conservative. And now that we're on our conservative model right here, this so far at least looks like a little bit better, right? Now we actually check, did we make the move we were looking for? It's right around 30 points inside of the Nasdaq. Did we bounce 30 points here? No, we fell a little bit short, only 25, and then price actions just continued to sell off. So inside of the Nasdaq, we know that the last model is the one that we now actually have to use, which is our Doomsday Conservative model. And that model has already hit that first target that we'd be looking for. We're looking for a bare minimum move of right around 33 points, let's call it. We've already made a move of 38 points. So we know inside of the Nasdaq, the Doomsday Conservative model is the one to use if you're looking to try and play any fades. So that already gives you an idea of on the sphere here, the Nasdaq is not on the Scalper, it's not on the aggressive, it's not on the Doomsday Aggressive, not even on the conservative, but rather on the Doomsday Conservative. So at the very extreme end in terms of volatility. Come back in, now we can move down to the Russell here. and we'll load back in our scalper to start the same process from the beginning. And it's very repetitive. That, I think, is the beauty of this process. So inside of the Russell, you'll see we're just chopping around inside of the scalper model. So the scalper is still the one being respected. So far we have the Russell on the scalper, the Dow on the scalper, the S&P we need to come back and check on, but so far was respecting the scalper. Now let's move on to gold and silver, which have the scalpers, and then we'll go through the final four markets. So next we have gold here. Inside of gold, we're still inside of our scalper volatility box sign lines, haven't gone outside of any of the clouds, haven't even breached the sign lines, so we know gold also respected on the scalper. And then finally, silver here, take a look, very similar as well. So gold, silver, so far on the scalper. Let's touch right back in on the S&P as well and see if price action is still holding this level. So far, we're still holding our clouds. If we see an edge signal here, that's one of these green arrows, then we know that this trade also is telling us that we're officially in oversold territory. And if we get an entry at the sign entry line, then I'm looking for a long right here. So far, everything is working out the way we'd expect. The S&P, the Dow off of the scalper, the Nasdaq on the very extreme end, which also is your hint that, hey, you expect volatility in the S&P and the Dow to continue to increase as the day progresses. Now let's move into the 30-year. So inside of the 30-year, you'll see the scalper's plotting, but we're still observing this market's. The 30-year fell right into the scalper right here towards the edge of that 6 to 7 a.m. hour when the market's open, the indices, and we bounce from there. So we know that so far even the scalper is still being respected inside of the 30-year, which means even the aggressive is. If I actually load in the aggressive to demonstrate this point, inside of the aggressive here, you'll see we're still inside of our lines, letting us know that the aggressive volatility box model is the one that we can continue to use for the 30-year. Now we keep moving on down the line. We have crude oil next. Now inside of crude here, we've breached our upper volatility box, which lets us know that, hey, crude is experiencing a bit more volatility than usual. We cannot use the aggressive. Let's try now what happens in the Doomsday aggressive model. So I'll load that in, see if that was respected or if we went outside of the clouds here as well. So inside of the Doomsday aggressive, we also went outside of the clouds. So we know that crude also a little bit more volatility. So let's come back in now. We switch to our conservative. And the conservative is the model which has encompassed price action inside of crude. Price rallied into our volatility box models and then has sold off at least that minimum distance we'd be looking for, which in crude was right around, let's say, 30 cents. We've made a move all the way down more like 50 cents so far and still looks like crude will keep falling. So inside of crude here, we can adapt this where, hey, it's not the aggressive, it's not the Doomsday aggressive, but it's the conservative volatility box models that we have to use. Now let's come in and repeat this exercise for our final two markets. We have natural gas, come right back inside of the aggressive volatility box models. Now inside of natural gas, very similar to crude, we've broken outside of our aggressive volatility box model, so we keep adapting. Now we come into the Doomsday aggressive, take a look at what price action looks like here. So inside of the Doomsday aggressive, so far we're holding this. The bare minimum move we'd like to see for us to continue to be able to use this model, right around 77 natural gas ticks. So far, we've made a move of right around only 40 natural gas ticks. So we need to still see about 37 more. 77 would take us to a price of right around 5.929, 5.93. So that's where natural gas needs to fall to in order for us to know that, hey, we can continue to use the Doomsday aggressive models. So we can pen this right here. So we can say something like active test. Just to adapt this, and then we'll say natural gas is not on the aggressive, but it's on the Doomsday aggressive, and we have an active test. And this is true in the S&P as well. Let me just format this a little bit. Okay, perfect. So far we know natural gas off of the Doomsday aggressive, but we need to come back and check in to see what happens here. Crude on the conservative. Nasdaq is the one market which is way extreme on the other side, Doomsday conservative, and so far the other indices are all on their scalper models. We have one final market, which is copper, so let's come back in and visit copper now. Now inside of copper here, we're right inside of our aggressive volatility box lines, so still these models are being respected. In copper, we could continue to use the aggressive models. So now we have a landscape of what volatility looks like, at least as of right now. There's two markets we at least need to come back and check in on, and we can revisit all 10 real quick. But so far the S&P has an active test, and so far natural gas has an active test. So let's come in, take a look to see if anything has changed here. So right back into the S&P, we load in our scalper. And so far you'll see price action's trying to really gather its footing right here in the scalper on the S&P, trying to bounce from there. We need to see at least a minimum move, we said, of what, 5.25 points in the S&P, which would take us to a price of right around 4325.75. So that's the price we need to beat. Let's go ahead and write that down as well. So we'll say something like 4325.75 just so we have a note. And then inside of natural gas here, off of our Doomsday Aggressive, you'll see natural gas is starting to now really get going here on the short side. The price we wanted to see, I believe, was 5.93. Let me just double check that. So we're looking for about 77, 78 ticks. Yep, so that would take us to right around that 5.93 mark. So if we see natural gas just continue to keep selling down a little bit further, then we know that, hey, this is the market that we can continue to use and focus on with the Doomsday Aggressive models. So I'll pause the video here. I'll touch back in right around 7:25 a.m. Pacific. It's currently 7:12 a.m. Pacific. So we'll give the market around 13 more minutes to prove some of those active tests. And then I'll finally conclude with what volatility looks like. And that's what's sent out to all members in that morning volatility note. All right, so now let's revisit what volatility currently looks like. It's currently 7:28 a.m. The morning note has just been sent out. I'll show you what note was sent out. This was the volatility that we had as of right around 7 a.m. or so, right? That's when we had performed the exercise. You'll see the volatility since then has drastically changed. Just to bring you back to where we were at before all of the volatility started to pick up, inside of the S&P, the Dow, we were on the Scalper. The Nasdaq was the one market, which was our clue that Doomsday Conservative is the model being used, meaning we expect these indices to slowly start to catch up, at least in terms of volatility here. The Russell was on its Scalper, same thing right here, a little bit less volatility. Expect that to slowly at least start to meet in the middle with the Nasdaq. The 30-year bond on the aggressive, crude off of the conservative, natural gas was on the Doomsday Aggressive with an active test, copper was on the aggressive, and then gold, silver were off of the scalper. Now, if we take a look at the note that was actually sent just a few minutes ago, and then I'll show you charts, you'll see this has changed drastically. The S&P now came all the way to the conservative with an active test, so that's one sign of increased volatility. The Dow came all the way to the conservative as well, also with an active test here. The Russell moved from the scalper now onto the aggressive. So despite being the small cap index, even this market started to see a bit more volatility. The Nasdaq continued with the Doomsday Conservative, the 30-year bond aggressive, crude conservative, natural gas still had the active test. Here you'll see price action started to actually rally a little bit. We fell short of the target we were looking for, so that's something we still need to monitor, keep a lookout for, that we hit that 5.93 mark a little bit closer compared to going outside of the clouds. Copper still on the aggressive, and then gold and silver still on the scalper. So in terms of where we saw volatility stay consistent based on where we had seen it, that was really crude, the 30-year, Nasdaq, along with our copper, gold, and silver markets right down here. Natural gas still has the active test, but a majority of the volatility came inside of the three other indices here, the S&P, the Dow, and the Russell. Now let's come into our charts and take a look to see how that looks like just visualized a little bit more. So the S&P here, you'll see just continuing to keep falling here. Inside of the conservative now, we've seen price action hit our clouds, and this is the active test we're looking to see what happens at this point. Does the S&P bounce from here, or do we go outside of the clouds? We just went outside of the clouds. We didn't see the edge signal, so now the S&P is caught all the way up to the Nasdaq, and we at least expected something like this to happen once we had seen that the Nasdaq was on its Doomsday Conservative models. So now the S&P, we can even adjust to the Doomsday Conservative models on this chart with yet another active test. So we can say something like Doomsday Conservative here. Now inside of the Dow futures, if we pull that up, inside of the Dow, we were on the conservative. I'm guessing we've already broken past the conservative clouds here too. So now we're off of our Doomsday Conservative clouds as well, also with another active test. So we can update this. Whoops. And active test here. And now we know that essentially all of our major index markets all on the Doomsday Conservative. So now volatility is caught all the way up. Let's take a look at the Russell. Russell here off of the aggressive. So far, we've seen a breach. We now have the edge signal forming. If the signal continues to print right here, this trade will be active. So now this trade is active. Any retests at the sign line are the ones that we're looking to trade. Stop is outside of the clouds. And that first target that we're looking for, you can see that in the labels up here as well, right near that 2221.6 price area, which takes us to somewhere right around this zone right here, a little bit above the market pulse as well. So hopefully this video, while it was a bit longer, gives you a very detailed idea of how to adapt to volatility as we're seeing some of these sell-offs in the marketplace, how you can use the clues such as the ones in the Nasdaq, letting you know you expect volatility in other markets to start to increase, and also know exactly where you'd like to spend your attention and focus in terms of trying to take advantage of trades. All right, I hope this video was helpful. Take care, everyone. Good luck trading this week. We can already see volatility picking up, so I hope that you can use this volatility and turn that into something productive and profitable for your accounts. All right, take care.